the story we want to talk about is the story that you broke today, the story of how Africa has been struggling to bring down the cost of money, except for a few countries. And you do mention one country where it effectively works, South Africa. But let's talk first of all about what you found when you did your research for the story.
Well, I'd love to say that I broke the story, but unfortunately it's something that African central bankers have been concerned about for a good 2 years now. Ever since the onset of financial crisis, banks indeed all over the world have been cutting their interest rates to try and put a bit of a zip back into the life of their economies and stimulate growth through cheaper credit. In Africa, it hasn't really worked at all. I mean, real interest rates in places like Ghana, Kenya, Zambia, Uganda have remained stubbornly high. This isn't to say it's a uniquely African problem. I mean, obviously, if you look at what was happening in the United Kingdom or the United States in the middle of the financial crisis, central banks axed their official lending rates to virtually 0%. But then commercial banks are still so scared that any counterparties they lent money to might go bust.
Yeah.
That this was a far greater concern to them. They in turn imposed punitive lending rates.
Yeah.
But whereas in a developed world where they've then flooded their economies obviously with cheap money, and the money markets have eased up, in Africa that hasn't happened.
What has been the main problem in getting those interest rates down?
Well, one of the big issues that the banks always complain about is a lack of confidence in any individual or company that they might lend money to. Kenya has sought to address this by introducing a credit reference bureau, which effectively allows banking communities to pull up a database of individuals and companies and go through their credit history, find out if they've got any outstanding loans or whether they've defaulted in the past. And it's like a sort of credit black book, I suppose. But unfortunately, something like that is going to take a good 10 or 15 years to flush out any bad debtors who might be lurking in the system. So although, yes, it will increase credit transparency and give banks extra confidence, it won't have any sort of real impact on reducing bank lending rates, or at least taking away that reason for banks not to introduce cheap lending rates. It won't have that effect for a good decade or so, unfortunately.
Pamela, you look at African countries and you do look at the economic systems and some of the monetary policy system that they have in place. From what Ed has written, what do you see as the main problem in trying to get those monetary policy mechanisms to work?
I think firstly we need to differentiate between the interest rate channel of monetary policy or the interest rate channel of the transmission mechanism of monetary policy and other transmission mechanisms or other channels. Certainly what Ed has said is certainly true. There's very little movement in terms of the lending rates that consumers and banks, and companies face compared to policy rates. But that is not the only channel that monetary policy affects the economy through. There's also the currency specifically, and that is much more effective and much more quicker in terms of affecting the economy. In terms of specifically the interest rate channel, I mean, I think some of the problems that he highlighted, the fact that banks don't necessarily know when lending to somebody how reliable they are as a borrower, and the solution that Kenya has come up with a credit reference bureau is trying to address that. There are other problems. I think if you are going to lend to somebody, you need to have the confidence that actually they have the right to the title to the underlying commodity that they are buying or that the bank is financing. And if in cases where that property right is not clearly defined, then it becomes much more difficult and much more risky for a bank to commit to that kind of
Would there be
financing.
other options that would help African countries be able to reduce the cost of money? Because this is essentially what we're talking about.
Well, it is a structural problem and something that unfortunately monetary policy or central banks
Is it just monetary policy alone that can address this?
No, it's not. It's
right.
not.
Let's talk about the options.
Well, the one that the Credit Reference Bureau, making sure that there is a sharing of information in terms of the creditworthiness of potential borrowers. That's one. Strengthening property rights, making sure that if you buy a piece of land, you actually have the right to that piece of land, or if you are lending to somebody who's going to buy a piece of land, they actually have the right to that piece of land, so that if they fail to honor their commitments, the bank has the right to attach or to claim that piece of land as their own, so that they can be able to offset that.
Yeah. Do we need to think a little bit out of the box here and perhaps not look at solutions that have been prized by the development of economic policy over the years and try and find a solution that's uniquely African, if you like?
In what way, for me to ask?
In the way of trying to lower the cost of credit.
Well, I think...
do we remain bound by the economic systems that we have in place that are operating in this country?
Not necessarily. I think the point I want to stress again is that the effectiveness of monetary policy in affecting interest rates that consumers face is not there, but the effectiveness of monetary policy in affecting the economy is there. So you've got to make that distinction, first of all. As far as the policy side is concerned, I don't think there is much concern. Whenever central banks tighten monetary policy, economies do slow down. Whenever they loosen monetary policy, economies do strengthen. So the effectiveness of monetary policy is not in question. I think the cleanness or the effectiveness of the credit channel is not there, and that needs to be addressed. But it's not something that monetary policy makers can address on their own. Indeed.
Ed, we speak a lot about Kenya because I think it's been the most visible in trying to deal with this situation. I mean, we've seen the central bank cutting interest rates at a time when we've seen inflation accelerating. Apart from Kenya, are there other examples where we have seen innovative solutions being sought in a bid to try and fix the problem?
Competition is, increased competition between banks is a key factor in all this. Kenya's been talking about this, Ghana's been trying to do it. Zambia's been talking about consolidation in the banking sector as well. But I think it comes down to the history of some of the banks in Africa. Over many, many years, that their primary function was simply to bankroll government spending and government operations. And they're taking time to adjust to sort of a more commercial and aggressive environment where they have to go out and seek loans and make money out of lending to businesses and to the real economy, which is, after all, what a bank should be doing. But at the moment, for many, many banks, it's still far easier and less risky to lend money to the government in a form of short-term government securities than it is to go and lend money to long-term business ventures, which may indeed go bust. So it's a question of changing the whole mindset of some of these banks, and the only way to really do that is to increase competition. And I know we sort of
from foreigners, or is it just domestic competition that we're talking about?
Foreigners would certainly help shake it up. Of course, encouraging more foreign bank participation in your economy is always going to be politically controversial.
Absolutely.
I don't want to start naming names and pointing fingers, but I mean, even when Barclays, of course, came into South Africa, the finance ministry clearly looked very, very hard at the deal, and I imagine they were having to assess sort of how risky it would have been to having HSBC coming in to take over Nedbank here.
In fact, there have been suggestions that perhaps the Nedbank, the HSBC deal fell flat because of considerations around who would be controlling the final product that came out of the acquisition.
Yeah, we never really got to the bottom of why HSBC left them at the altar.
When you break that story, you must come back right here.
I will be giving you a ring after I've already filed it to my desk.
It did. Pumelelo, so what do we do with African countries when they're struggling to get the right systems working to try and reduce the cost of credit and the cost of money in their economies? Is this a question that should be sent to the World Bank? Is this for the IMF to come and try and get give these guys the technical support they need to be able to get the right systems working?
I think a commitment to keeping inflation low and a demonstrable commitment to keeping inflation low will help in some ways. One of the things that Ed has said is that you need competition, but also competition on the demand side, demand for credit as well, not just on the supply of credit. In terms of competition relative to lending to government. In a high interest rate environment, it's much cheaper and probably less hassle lending to the government, because you know that if you lend to them, you're going to get your money back. But in a low interest rate, low inflation, low interest rate environment, then it forces banks to seek other avenues of trying to earn the money. So a commitment to low inflation is one.
Let's talk about Nigeria, because in Nigeria, for instance, we saw the central bank coming in and having to rescue those banks after they had lent money to people who who, I don't know whether it was because they were not vetted properly, but were unable to pay the money back. And then you had public funds being poured to try and rescue the situation. Would Nigeria be helped by a system that essentially looks at the competition within and try and inject, maybe get foreigners to come in and try and get more, intensify competition, if you like?
I think learning to manage risk is something that is going to be an ongoing process, of course. You mentioned Nigeria specifically. It might well be said that the banks, the exposures that they got themselves in was probably not prudent enough. In time, I think banks are going to learn. They are going to lose money in some cases. Some banks will go bankrupt somewhere. And they are going to learn to avoid certain risks and to accept certain risks and to accept certain risks at the appropriate price. And I think in the case that you indicated there, it's probable that the risks that they were taking, they were not being compensated adequately for the risks that they were taking there. It's something that will develop with time.
We need time.
At 100 years from now, some of the banks are going to be existing, some are not going to be existing, and those that will exist, in most cases, will be because they they were prudent enough in their lending decisions.
Now, Ed, you cover investment for Reuters across Africa. You document investors coming still into Africa, and now Africa is now being regarded as a frontier market. And we've been seeing investors coming. And I mean, we can talk about what we've seen here in South Africa, where we do know that they come in for South African bonds, they come in on the equities front. But could you paint a picture for us, at least in terms of the investment flows that we're seeing coming into Africa? Where has that been coming from, and how strong has that been?
Well, the overarching story last year was in Africa. It was more South Africa, to be honest. And that was part of the whole global search for yield in emerging markets, given that interest rates in developed countries were going to be so low for so long. And of course we had $10 billion or whatever net flowing into South African bond markets and the rand going through the roof. This year it's becoming a bit more nuanced, and investors are starting to look beyond the curve and thinking, okay, South Africa is now very expensive, and where else can we find similar yield? And they're being forced to take more risks, but they're seeking greater returns. And so countries like Kenya and Nigeria, which do have they have relatively liquid secondary bond markets. But even Zambia now, investors are looking to buy short-term government debt at source, effectively, and holding it for, say, 3 months or 6 months. And I think in October last year, there was $100 million worth of foreign buying of short-term Zambian debt. So there's serious sums of money going into relatively small economies. So obviously that then imposes an exchange rate consequence that the government has to deal with and the central bank has to deal with. So again, it all puts this whole issue of monetary policy and FX policy under the microscope. I mean, 5, 6, 7 years ago, these currencies in Uganda and Zambia or wherever were largely driven by trade flows. A mining company selling ore or wanting to import certain goods and equipment, and oil importers bringing in fuel. But now that they're actually becoming tradable currencies in their own right, it's too early to say that they are sort of, quote, full emerging market tradable currencies, but they're certainly moving in that direction, and hence why more and more outsiders are looking into how interest rate policies work and how the money markets work in these countries.